So good afternoon, everyone. My name is Maurya Hanspal, and in this session, we're going to continue our discussion on value investing. So what exactly we were talking about the value investing? Okay. So talking about the concept of value investing, when we talk about, we're going to introduce here topic talking about the Benjamin Graham model. So what exactly is the Benjamin Graham model, and why is the Benjamin Graham model useful? See, again, all these models that were suggested by the person, they might not stand true in the present day scenario, because the situations have completely changed. And that is one thing. And apart from that, nowadays some new models have also come in, and that we will be talking about that as well. Like there was a person called Benjamin Graham, so he invented this model, and he said by using this model you can calculate the value of a company. So it basically suggested the formula V is nothing but the value. He said the value of the company is equal to EPS into the 8.5 plus G. 8.5 and G is the growth rate. Okay, so basically, like he suggested this formula. Now, what is 8.5 and why the specific number of 8.5 has come in here? 8.5 is the P ratio of a zero growth stock. P ratio is nothing but it tells you how much well the stock is doing. And it takes into consideration both the share price of the company and the EPS of the company. For all of those who want to know completely about the different types of ratios, valuation ratios, and all these ratios, try seeing my previous videos on fundamental analysis where I've talked about all these kinds of ratios. Okay. So G is basically the R assuming the P ratio of a zero growth stock. It means the growth rate of the stock is zero, and just for the sake of taking as a conservative measure, or for the sake of simplicity, that the P ratio is the P ratio of a zero growth stock. Okay. Now, why this 8.5? Why did it took like specifically 8.5? Again, in my videos of technical analysis, I talked about behavioral finance. So these were like some of the assumptions like which were taken by the financial analysts and big investment persons. And even now, these assumptions people take. Okay, so that thing you need to go. And this was like one of the assumptions as per the behavioral finance, which was taken by this person, Benjamin Graham. Okay, so like do not worry about that and try to find the logic that why this 8.5 has come into place. Okay, this is just on the basis of this person. Like this value can be like 6.5 for some person. This value can be like 10.5 for some person. So just assume that it's the P ratio of a zero growth stock. Now this P ratio can be 7, it can be 12 even. And nowadays, even the P ratios of the companies have crossed 100 also. Okay, so try to take an average P ratio here. Like if you're talking about the whole economy or whole economy of India, then try taking the average of all the P ratios of all the companies being listed on the stock exchange. If you're taking into consideration only one particular sector or only one particular industry, so let's say that you are taking into consideration only the pharma sector, then take the average of the P ratio of only the pharma sectors. Okay. Then the second thing he talked about is the value of the company will come by using this formula. And for example, if the value of the company comes out to be like 200, but in reality the company is being traded at 250 rupees, it means the company is overvalued. And if the value comes out to be 200, and in the current market the value is being traded at like 150 rupees, it means the company is undervalued. That is this fair value at the price the company has to come in. Okay. The second model, which was not suggested by the Benjamin Graham, it's the other model, is the net investing model. So basically, it shows the formula is the net current assets value per share. And how to find the net current assets? Subtract the total liabilities, that is both the non-current and the current liabilities, and the preference dividend. Add the total liabilities and the preference dividend and subtract it from the current liabilities and divided by the shares outstanding. So it basically means how much value has been created on the basis of the current assets of the share. Okay. The higher this ratio, it is best for the company. Okay. The next model he talked about when we talk about the Peter Lynch model. So what exactly is the Peter Lynch model? A few of the facts were suggested by Mr. Peter Lynch. Again, Peter Lynch is the person and he came up with his own model. And he benchmarks or like he laid down like some of the criteria or some of the benchmarks which can help you to analyze your portfolio or go forward for your portfolio. He said only buy what you understand. So it's basically said do not buy anything randomly in the market, like just because it appears cheap or you have heard about it. Try buy things like what you understand and what you have knowledge about. Like for example, if you have no knowledge about the commodities market, then like do not trade in commodities. If you have no knowledge about like the metal industry, then no need to buy the metal industry, even if the metal industry is going on a boom. Though through the portfolio strategy and mutual funds, you people can buy, because ultimately the mutual fund person will have the knowledge about all these sectors, and that person will be managing your portfolio. But this model is in the individualistic sense. It means that you are not taking help of any external party. So it basically says only buy what you understand. Try to analyze the specific industries or a set of industries and particular stocks, and only buy those that you buy. In case you do not understand any kind of stock or industry, then do not take the risk of buying it. It ignore the concept of the portfolio and the mutual funds as we have in the present day scenario. Okay. And the second thing is said, he said, always do your homework. By always doing our homework, he said, if you're trying to analyze a company, if you're trying to understand the company, always do your homework. That is, read the annual reports of the company from A to Z. Try to see the past performance of the company. Try to see the future projection of the company. See the profit and loss statement of the company, which is also called the income statement. See the balance sheet of the company, which is also called the position statement. See the cash flow statement. See the statement of equities, and also refer to the notes to accounts. So all these things you need to verify, right? Also, like you need to see that what are the kind of ratios of the company. And if you want to know about the ratios of the company, a separate series have been made on like fundamental analysis, and that you can go and watch. So talking about all these things you need to know, right? So the one thing that you need to know about is calculating the different kinds of ratios, because we have a kind of different ratios for different industries. And these are not just the basic 26 ratios like that we see in the case of a graduation times, a post-graduation times in PB and MCOM. Then more than 100 plus ratios for different sectors. There are like different ratios for banking industry. There are different ratios for insurance industry. There are different ratios for the metal industry, pharma industry. So you need to analyze these companies on the basis of the ratios and need to see that whether these companies are having a future potential or not. And if you can came to the conclusion on the basis of your homework or your study, then invest in those companies. But if you cannot come to the conclusion and you really feel that still you are like unable to understand the company, or even if you understand and you get to know that the company might not perform well in future, then avoid such companies. And by doing the homework, he means all your discussion, all your like research into those companies. Then it says invest for a long run. See, in the short term, the market will fluctuate a lot, but in the long run, the people would get their returns. Okay, so always try to like invest for a long run, like for a long run period. That you need to understand, because in the long run, the market tends to be stable. At a certain point of year, your market might give you a negative return. Market might be into losses. But when you calculate the CAGR, that is the total CAGR over a period of time, it tends to increase. Then the ratio analysis. He said all kinds of ratio analysis must be done for the companies. And there can be like different kinds of ratio analysis. Like when we talked about the liquidity ratios. So liquidity ratios basically talk about, is the company having like sufficient assets to pay off the liabilities of the company. Then we calculate the capital structure ratios. Then we talk about the debt to equity status of the company, how much debt the company is having, how much equity the company is having, how much it can afford to have. Because sometimes the companies are having excessive debts the companies have, and that can create a further problem for the company, right? And sometimes the debt is also good. Until what point the debt can also be good? When your ROE, the return on equity or the return on investment, so the return on equity is coming more than the cost of debt. At that point of time, you can like invest into like debt. So that thing you need to know. So all these things you need to analyze well before going to invest into a company. Because if your ROE, the return on equity, or the return on your total investment, if it gets less than the cost of debt, it can create a problem for the company. So these things you need to understand in very detail. Okay. So these were like some of the principles like that was suggested by the Peter Lynch model, and these are not the principles you have to follow always. The principles can be like different for different persons. Okay, that you people can see. So that's all for today. I'll see you in the next.